Hello and welcome to this special report here at XM.com. We'll be discussing the stock market outlook for 2023. It has been a difficult year for equity markets given the rapid rise in interest rates. And although a recession is a real possibility next year, the outlook for stocks may not be all doom and gloom. I'm Maria Pachordis, and joining me is Senior Investment Analyst Marios Hadjikyriacos and Junior Investment Analyst Stefanos Ikonomidis. So Marios, let's start with the U.S. market. Can you tell us about the core problems there? What will global economic weakness mean for the S&P 500?
Hello, Maria. So it's certainly been a difficult year for stock markets. The main problem was, the Fed raising interest rates to crash inflation. So higher interest rates are toxic for riskier assets like stocks because what usually happens is valuations compress when interest rates are very high. And of course, higher interest rates can inflict damage on the economy itself. It makes it more difficult for everyone to borrow. The goal really is to slow down the economy, and that's how inflation comes down. But along with that, you have the risk of going into a recession, for example, if the economy slows too much, and that can hurt corporate earnings. So what we've seen most of this year was a compression in valuations. So the valuation multiple of the S&P 500 and of most American markets has really come down. But what we haven't seen is earnings estimates for next year coming down. And that is strange because if you look at a lot of the forward-looking indicators, a lot of the stuff that tells us how the economy is going to look next year, well, most of that is warning about a recession next year. New business orders are on the decline. The housing market is very weak. Consumer confidence is low. Consumer retailers are swimming in inventory. They can't unload. And all of those are classic recession warnings. And of course, the biggest one is the inversion of the yield curve. That's bond traders betting on a weaker economy. So you have this dichotomy really where the economic indicators are telling you a weaker economy probably lies ahead, but the analysts haven't revised down their earnings estimates for next year. And that, I think, poses trouble for US markets. So the way I see it is you have 3 core problems with US markets. First, valuations are still elevated. We just described how valuations came down, but by historical standards, they're still pretty expensive. The S&P 500, as we speak, is trading at a forward earnings multiple of 17.5. Now, if you go back to the last decade, usually bear markets conclude with a multiple closer to 14 or maybe even below. So yes, we've seen progress on the valuation front, but we still probably have some more room to go. And at the same time, those earnings might be revised lower in case we start seeing the economic weakness that the leading indicators are warning of. So those are the 2 biggest problems. The third one is liquidity. So the Fed is draining liquidity from the financial system. That we've only done that once in the past, quantitative tightening. That was the experience of 2018. Now that ended with a stock market crash. In the recent months, we've seen the effects. This effect was nullified by some actions from the US Treasury. So what happened was the US Treasury, because we are approaching a debt ceiling, the US Treasury was decreasing the amount of cash it holds at the Fed, essentially. So without going into too much detail, what that did was it released liquidity back into the market and it negated the quantitative tightening that the Fed was doing for the last couple of months. That, I think, is why we saw the relief rally in the stock market, but it's also an effect that will fade next year because the Treasury will have to rebuild its cash balance at some point, therefore draining liquidity from the market. The Fed continues to do quantitative tightening, and the European Central Bank just announced plans to follow down the same path next year.
Turning to the euro area now, the odds of a deeper recession in Europe continue to increase. So, Stefanos, how did major European indices perform against their US counterparts in 2022, and how might they perform going forward? What are the risks for European equities in the new year?
Hello, Maria. As you correctly said, the euro area and the UK are more likely than the US to dip into a severe recession. And the main reason behind this is that inflationary pressures in Europe are mostly exogenous and stem from the supply side, making monetary interventions less effective. Despite the deteriorating macroeconomic conditions and the greater uncertainty, surprisingly, major European indices outperformed their US counterparts in 2022 and have rallied strongly in the last quarter. But this advance could set the stage for a decline in early 2023 when earnings will start getting downgraded due to the severe recession that Europe could be in and the earning expectations that will likely be darker. Now, looking forward, on the bright side, European equity markets currently seem to be trading in closer to their fair value, making their downside potential limited and offering an attractive point in case we see an impending sell-off, while US indices retain inflated valuations despite their massive underperformance in 2022. Now, on the other hand, the greater risk for European equities remains an overly restrictive monetary policy that inflicts severe damage to corporate earnings, more than expected of course, with the ECB's quantitative tightening that's set to start in March, posing the greatest threat for risky assets.
I would only add to what Stefano said. The other big risk, for me at least in Europe, is the adverse weather. So if you get a cold freeze during the winter, well, suddenly that might reinvigorate, that might reawaken the energy crisis, right? So a different way of saying that is the severity of the recession in Europe might ultimately be decided by the weather, which is very unpredictable, obviously. So it's a difficult spot, although I would agree with Stefano's valuations in Europe are much more attractive, which suggests that the downside is probably more limited in European assets.
Now, to sum up, is there cause for optimism in global stock markets? What could investors take advantage of in this environment?
I definitely think there is cause for optimism. So, let's take a step back. We are not doing doom and gloom here. We're just analyzing the data. The data suggests the global economy is weakening. The data suggests that the recession will be difficult to avoid, but at the same time, that's not the end of the world, right? So we've had recessions before. The world didn't end. We made it through. Every crisis passes, ultimately. And the real question for stock markets is the following. How severe will the recession be? How long and how deep will it be? Now, on that front, I'm optimistic. I think that we are going to get a recession, but I think it's going to be mild. So it might be relatively brief and relatively shallow, at least in America. And the argument is very simple. What is causing the recession? It's not the banking system failing. It's not some massive shock to the system. It's really the Fed raising interest rates and its government spending being dialed back. Well, if policymakers are essentially engineering an economic slowdown to crush inflation, well, they can also turn the ship around before it sinks completely, if that makes sense, right? So the worst recessions you usually have are recessions caused by some external shock. This is an endogenous shock. It's a shock generated by the system itself. So I'm confident that it won't be, apocalypse, hopefully. I will also throw in some numbers to give people some perspective. The average drawdown, the average decline in the S&P 500 over the last 100 years has been around 33% in bear markets. Now that would put the S&P 500 close to the 3,200 level, which is more or less in line with what fair value might be if you assume, the forward earnings multiple is going to be around 14 or 15 and earnings are going to come down a little bit. So I'm seeing a situation where the S&P 500 can drop quite significantly from current levels, but as we approach that 3,200 area, I think that investors would be looking to enter the market. So if you're a long-term investor, this drawdown might be a gift for you because it might provide you a more attractive entry point to take advantage of, right? So that's how I would approach it. That's the angle I would approach it from.
And one more thing I would like to add is that I think that the situation in both the war in Ukraine and the COVID situation in China cannot get worse. I think from now on they can only get better. So a de-escalation in the war or a clear exit from the zero COVID policies in China could provide some upside momentum for risky assets going forward into 2023.
Agreed very much. I think we both agree on this, Stefan, that we are looking at a period of weakness, but by the end of the year, we might be looking forward to the eventual recovery. And remember, the stock market bottoms around 3 to 4 months before the economic data does. So it seems strange, but usually what happens is the ideal period to enter the market is right when the economic outlook looks to be at its worst, right?
Marios, Stefanos, thanks so much. And thanks for joining us for this special report here at XM.com.